The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
For decades, people have tried to copy Warren Buffett. They study his stock picks. They analyze his letters. They wait for him to make a move, hoping to follow it. But almost everyone misses the most important thing about how Buffett actually built his success. He didn't do it by timing the market. He didn't do it by predicting crashes. And he didn't do it by waiting for perfect conditions. In fact, if you look closely, you'll realize something uncomfortable. The way most people think Buffett invests is the exact opposite of how he actually does. And that misunderstanding is costing people far more than they realize. Not just in stocks, but in housing, careers, and long-term wealth. Now that Warren Buffett is stepping back, it's the perfect moment to talk about the mindset that actually made him successful and why most people still get it wrong. Ask the average person why Buffett succeeded, and you'll usually hear some version of this. He knows when to buy. He waits for crashes. Or he's patient and buys at the bottom. That story feels comforting because it suggests success comes from waiting, from avoiding risk, from sitting on the sidelines until everything feels safe. But here's the problem. That story isn't supported by Buffett's actual behavior. And once you see that, a lot of modern investing advice starts to fall apart. If you study Buffett's career honestly, you see a pattern that almost no one talks about. He bought businesses when the market felt uncertain, when headlines were negative, when conditions were unclear. And often when people were still scared, he didn't wait for confirmation that things had reset. He didn't wait for the economy to feel strong, and he didn't wait for prices to feel comfortable. What he waited for wasn't timing, it was understanding. Buffett's real advantage was not forecasting, it was recognizing structural advantages. He looked for businesses with durable demand, pricing power, long useful lives, and systems that benefited from time. Once he understood the structure, short-term conditions mattered far less. That's the part most people miss. Because waiting feels smart, but understanding is what actually reduces risk. Waiting feels responsible. It feels cautious. It feels disciplined. It feels like you're avoiding mistakes. But Buffett understood something most people don't. The biggest risk isn't volatility. The biggest risk is never participating. If you sit out too long waiting for perfect conditions, the cost isn't visible, but it compounds quietly. Lost time, lost ownership, lost optionality. Buffett didn't avoid uncertainty, he accepted it. Because he understood the system he was investing in. Most people obsess over price risk. Is this too expensive? What if it drops? What if I buy at the wrong time? Buffett focused on structural risk instead. Will this still matter in 10 years? Does demand persist? Does time work in my favor? That shift in thinking changes everything. Because once the structure is sound, timing becomes a secondary concern, not the primary one. This is where people get investing wrong. Modern investing advice often teaches people to wait. Wait for confirmation. Wait for better prices. Wait for the reset. Wait for the crash. Buffett's career quietly proves the opposite. He understood that. Markets don't ring a bell at the bottom. And waiting for certainty often means paying a higher price later. He didn't avoid risk. He avoided misunderstanding. This is where this mindset connects to something much bigger, because the same mistake people make with investing, they're now making with housing, waiting for the perfect market, waiting for prices to reset, waiting for conditions that no longer exist, just like investors waiting for crashes that never come. Buffett would recognize that mistake instantly. Buffett didn't win because he bought everything at the lowest price. He won because he bought durable assets. He held them through uncertainty, and he let time do the heavy lifting. Time in the system mattered more than perfect entry. That lesson applies far beyond stocks. This way of thinking is uncomfortable because it removes the illusion of control. You can't wait your way to certainty. You can't predict your way to safety. And you can't time your way around every risk. What you can do is understand the system you're entering and decide whether time helps or hurts you once you're inside it. That's what Buffett mastered. Warren Buffett didn't succeed because he predicted the future. He succeeded because he understood systems, respected time, and acted without waiting for perfection. And the people who struggle the most in investing, housing, or wealth are usually the ones waiting for the world to feel comfortable before they move. Buffett never waited for comfort. He waited for understanding. If there's one lesson to take from Buffett's career, it's this: waiting feels safe. Understanding creates opportunity. And if you're applying the wait for the reset mindset to other parts of your financial life, it might be worth asking whether you're protecting yourself or quietly excluding yourself.